My name is Ilse Treurnig, and it's my great pleasure to welcome all of you to MaRS, and more importantly, to a global leadership event at MaRS. We do a lot of things at MaRS, but the Global Leadership Series is quite special because we use this as a forum to tackle those really big chunky issues, and particularly to bring some new thinking from around the world to help us put our own work in context of the global environment and in the context of both the big challenges and the big solutions. So I hope everybody comes with a big expanse of receptive intellectual capacity this afternoon, and because this is a impact investing, that you also brought your heart. So we should have some fun. It's also my pleasure on behalf of our social innovation team, SIG at MaRS, and our Social Innovation Generation National Organization with Tim Drayman to welcome you to this as part of our social innovation stream. So my job today is to introduce our guest, and he's going to talk to us for 20 minutes or so, and then I'm going to ask him a few questions, and then we'll open it up for an interactive discussion. I know from this audience we'll have lots of great questions, so we want to make sure we leave lots of time for that interactive part. So Antony Bugg-Levine is the managing director of the Rockefeller Foundation in New York, where he leads initiatives in innovation and impact investing. He also teaches at the Columbia Business School and a course on business innovations in international development. Now, we know that's a whole other topic that we could spend the afternoon on. But he comes by his knowledge in that field honestly, because before joining Rockefeller, he worked as the country manager in a NGO, TechnoServe, in Kenya, which really was focused on business solutions to address the issues of poverty. He started his life, like many others in this field, and with a good, solid McKinsey career. And he is, like me, a fellow South African. So he did some work earlier in his career with the South African Human Rights Foundation, and also as a communications lead for the African National Congress in their late 1990s campaign. So I think as all of you who have friends from South Africa, any of us who've come through a society like that one that had a major transformation, there's sort of a set of tracks that it lays down in your soul somewhere that you don't ever shed. So it's terrific to see how some of that commitment and passion has followed Antony in his subsequent work. So Antony, welcome. Thank you very much for being here. We're delighted to hear some new thinking from the Rockefeller Foundation, but also from that vantage point, you have a really unique perspective on some of the emerging trends, both in the North American context, but more importantly also in a global context. So the floor is yours, and then we'll get into a conversation.
Great, thank you. And I do want to just open with a brief talk about the work we do on impact investing, and then really open it up for a conversation that I hope we can have, and all of us. But first, let me just say that it's a real honor for me to be both here in Toronto and specifically at MaRS. As Ilse mentioned, I'm a South African originally, and like many people, I assume some in this room, many of my family members ended up coming to Canada, and Canada and Toronto have been very good to my family. And so it's a real honor for me. This is really my second city. My family moved to Boston, but many of my extended family, some of whom I'll see tonight after this talk, are here in Toronto. And so for me to take this work and this thinking and bring it here, it is partly about bringing it home. And so it's great to be here in Toronto, and in MaRS specifically. I won't be speaking about the innovation work specifically tonight, but I do lead our innovation work at Rockefeller, and MaRS is definitely a bright spot on the global map around social innovation and the application of innovation in solving social problems. And so it's a particular honor to be in this beautiful building and this great resource, and I hope that my talk today and this conversation is worthy of both the place as well as the people I know who've come here and shared this stage before me. But I did want to talk to just a little bit about impact investing, and really three main themes. One is, what is the promise of impact investing? The second is, what are the challenges about getting to realize that promise? And the third is why you should care. So I just want to cover those 3 points briefly. But first, to begin with an explanation of a different question, which is why we care. And who are the Rockefeller Foundation and how have we come to this work? The Rockefeller Foundation, for those of you who don't know, is a foundation in the US, one of the first. And for 97 years, since our founding in 1913, we have been taking the assets that John Rockefeller left us and applying them to solve social problems. He gave us a very broad mandate. He said, I want you to use this resource for the goodness of mankind. And he said, giving my foundation any greater guidance would be antithetical to the idea that I'm creating an institution that will become professional at giving money away. What he said was, I give you a broad mandate and I leave it to you, the institution, to figure out how best to deploy that. And for many years, what the Rockefeller Foundation did to execute that mandate was give money away through grants and gifts. And initially in the early years, that was primarily to governments. And after the Second World War, that increasingly became to nonprofits. Many of you, through some connections, either through fellowships or other ways, are probably participating in industries in which the Rockefeller Foundation has touched your work. And that model of giving money away had immense successes in the 20th century. The Rockefeller Foundation in its early years was instrumental in developing the public health system. Those of you who work in public health probably know of that legacy. There were campaigns to eradicate diseases like yellow fever and smallpox, in which the Rockefeller Foundation's model was very effective. And quite famously, we were the driving force for many years behind what became the Green Revolution, primarily in Latin America and in South and East Asia, that increased crop yields and staved what many people anticipated to be hunger and desperation and wars that were going to come from the poor productivity of smallholder farmers' fields. The Rockefeller Foundation, employing the model of putting large amounts of charitable resources to work, addressed those problems effectively, working with governments and increasingly with nonprofits. So if that's our legacy, I think a legitimate question is then why are we talking about impact investing? And the answer to that question is, what worked in the 20th century, we do not believe will work in the 21st century. And the problems in the 21st century are accelerating at a pace and are developing a complexity that our old methods are not up to the task of solving. In the 21st century, we need new approaches, we need innovation that will enable us to tackle the problems of this world at their scale and at their complexity. And let me just take those two in turn. The problems we face now and the kinds of things the Rockefeller Foundation works on are much more complex, even though the problems of public health were complex enough. Increasingly, in a world in which solutions cannot be bounded in one place, where what one country does affects another country, looking at things like climate change, the development of public health systems, the major areas of work, the way that poor people are either brought out of poverty through their engagement with globalization or marginalized by globalization. These are incredibly complex issues. And relying simply on the tools that the 20th century left us with and giving gifts to nonprofits and governments is very important, but not enough. That's the question of complexity. The other one is a question of scale and what are the capital needs required to solve the problems we face. I'm not being ideological here when I say that the amount of money we have in government and in private charity is not enough to solve the problems of our day. That is not an ideological point of view. It is just an assertion of math. And let me be clear what I mean by that. We think of what we call the social balance sheet. For investors in the room, hopefully that'll something that resonates with you. What are the capital needs? How much money do we need to solve problems at scale? When I look at what it's going to take to provide decent housing and sanitation for everyone who currently lives in slums, and the many more millions of people, hundreds of millions of people who are likely to enter cities in the next decades, my housing people tell me with sanitation, that's probably a $5 to $10 trillion capital need. When we look at things like the work we do in African agriculture, how we're going to get African farms capitalized with irrigation, with fertilizer, environmentally sustainable, and yet it still needs to be capitalized, that's a multiple $100 billion investment a year. When we look at things like access to public health, for the countries who spend $20, $30, $100 per capita per year on public health, we simply need money. We need a lot more than money, but we're certainly going to require money at a hundreds of billions, if not trillions of dollars of scale to bring up the basic services of what we would consider the kind of world we want to live in. If your goal is simply to go to one village in Ghana and provide clean water for the people, you can do that with charity. If your goal is to go to one slum in India and build a school that will allow 100 students to have access to a decent education, you can do that with charity. But if your goal or your mandate, in our case, is to work at a more systemic level, to end poverty, to give everyone access to a decent education, to create a global health system that provides universal health access to all people, there simply is not enough money in charity and government alone to get the job done. And so when we look at the capital needs are in the trillions. Total international development assistance is $150, $160 billion. Maybe that'll get up to $200 billion. Total private giving around the world is a few $100 billion. A lot of that stays in local communities and does very good work in helping to provide food, provide shelter. But not a lot of that money gets abroad into addressing the more systemic problems of the world. So our social balance sheet has trillions of dollars of capital needs, and it has hundreds of billions of dollars at best of capital coming from private charity and government. So our work in impact investing comes from a very simple question, and that is, if you don't simply want to dabble in small solutions, as important as that is for the communities in which they exist, if you want to have either the ambition or you could say the arrogance of thinking that we can actually solve problems at a massive scale, we have to ask the question, if government and charity is not enough, where will we find the money to capitalize those solutions? And let me say that we do not believe that impact investing is the answer to where all the money will come from, but it is an answer to how we can close that gap. And the reason why that answer exists is because while there's a few $100 billion in private giving, and there's a few, very low few $100 billions of dollars in government assistance, and even within the governments working on their own people, the global capital markets include, depending how you measure it, between 50 and $100 trillion that are invested by for-profit investors every single day. So the question becomes not where will we find the money? We know where the money is. It's in for-profit investment. The question becomes, what will it take to unlock that for-profit investment so that it can complement philanthropy in addressing some of these problems at scale? So impact investing, so this gets to sort of where I said I'd go with this. That's why we care. We care because as a foundation, we know that the tools we developed in the 20th century of giving grants to NGOs and governments are crucial tools. But we also know that we need to face the world's 21st century problems with a full array of tools that come out of 21st century innovation. And impact investing is one of those innovations. So that's why we care. What is the promise of impact investing? Let me just stop being so analytical and tell you three concrete stories that I hope illustrate what the promise of impact investing is, at least anecdotally. Tonight, it's probably pretty soon, in the slums of Hyderabad, a young girl will wake up and she will leave her shack in that slum and will walk to a school that has an additional classroom, that has the capacity, because of the classroom they built last year, to give her a spot on the roster when that school was capped the year before. That school charges $10 per month for her to attend that school. It is a private school, but it provides an educational outcome better than the schools in the public school system. And frankly, for that girl, it's unlikely in her slum she would have had access to a school in her neighborhood anyway. That student is going to walk into that school and she'll get a decent education. That classroom was not expanded by charity, and it was not expanded by government. The classroom expanded because a company called the Indian School Finance Company extended a loan to the school, to the principal who owned that school, when they, through their own methodologies, assessed the fact that this school provided quality education and was in a position to repay that loan while keeping their tuition rates low enough that very poor families can send their children to that school. So someone will wake up tomorrow morning, very soon, this morning, her time, and go to a school that existed because an impact investor created a finance company to extend a loan to schools like that. And they've financed hundreds, and they're now moving out of Hyderabad. Right now, it's the middle of the night in eastern Congo, a part of the world in which very little in the formal sector functions well. And yet, in a few hours, there are farmers who will wake up in a village right on the Ugandan border, and they will go and they are growing coffee and vanilla. And when they harvest that coffee and vanilla, rather than selling it at the cutthroat prices that the local middlemen would have paid them in order to sell it on into, who knows how it's going to get out of there, but into a sort of low value value chain, those farmers, when they harvest those coffee and vanilla beans, are going to sell them at a much better price to an importer in Uganda, who is going to then export them into Europe. And the coffee might go to one of the high-end coffee shops, and the vanilla is going to go into one of the high-end fair trade value chains. Because of the logistical hassles, anyone who's worked in that area knows, that kind of deal is not something that the market can simply support on its own. For that deal to happen, someone had to extend credit to the farmers, to the company in Uganda to go and buy the goods from the farmer. The banks won't do that. I don't think many of you would lend to someone in Uganda who is importing from farmers in Congo. But an organization called Root Capital did. They provided a loan to the Ugandan company, and with that loan, that company was able to have cash available when the harvest occurred, so they could buy that product from the farmers, process it, sell it in a much higher value chain, make enough money to pay back the lender, and to pay the farmers a substantial premium on what they would otherwise have earned. Again, it did not take charity to make that happen. It did not take the government to intervene. It was an impact investor who said, we will extend a loan, and we will be paid back, but with that loan, we will both make money and also provide better opportunity for those people in Congo. Much closer to home here in Toronto, tomorrow morning, a young man will wake up, and he will go to a job that probably would not have been available to him had he simply been seeking employment, given his background, having not had a high school degree and not being put on the ladders of employment that many of us expect and that the employment market demands. Again, the organization that made that job available to him was not one that the government funded or one that charity was used to fund. Instead, the Social Capital Partners Investment Fund made a loan available to a company which then trains young people and gets them ready for the workforce and provides them with jobs. So once again, impact investing is making employment available. So here's the promise of impact investing. If you care about providing educational opportunities to girls in the slums of Hyderabad, if you care about helping farmers in the Congo improve their incomes, or if you care in Toronto about making job opportunities available and getting young people onto the first rung of an employment and a career, you are no longer limited to simply giving money to charity or waiting for the government to take care of the problem. Impact investing has given us a third tool for solving social problems, and that is you can make a for-profit investment. You can extend a loan to that school in Hyderabad. You can extend a loan to the company that's buying from the farmers, or you can make an equity or a debt investment in the kinds of companies that are supporting that young man in Toronto to find a job. That is the promise of impact investing, because if we do this, we can tap into the much larger pools of capital that exist for-profit investors who are looking not just to give their money away, but to make investments that generate financial return, that $100 trillion, but also can generate a social return. So that's the promise of impact investing. But I'm not here to sell you guys on an idea. I really hope we can have a real good debate about what this is going to take to pull it off. And so I want to briefly talk to you about the challenges in realizing that promise. At the Rockefeller Foundation, we do believe that impact investing is part of the answer to the question of what it will take for us to meet the 21st century challenges with worthy answers. And for this work, we, over the last few years, have met in forums like this and in one-on-one conversations with more than 1,000 investors and participants in this new industry around the world. we have been trying to understand what does it mean for a new industry of impact investing to emerge. And what we've done with those conversations is we've asked everyone a very simple question, and that is, what will it take for you to put more for-profit investment capital to work to solve more social and environmental problems more efficiently? We've asked that question of investors. We've asked that question of government. What can you do to facilitate more for-profit investment to be put to work to solve more social and environmental problems more efficiently? The answers to that question have really helped us understand where this industry is in its evolution and have clustered around 4 major themes. And our work at the Rockefeller Foundation is really about helping to catalyze responses to these 4 challenges. The first challenge that people came to us with is they said, in this new emerging industry of impact investment, we need leadership. And I think the issue in MaRS, I'm sure you've debated this, and many of you, around social entrepreneurship and the focus on the entrepreneur as the agent of change. That is a very important component of how an industry comes about. And in its first phase, impact investing has been pioneered by incredibly brave, visionary, and frankly, bullheaded entrepreneurs who are willing to look at a world in which everyone else thinks you only use for-profit investing to make money and you only solve social problems with charity, and have said, we have a different way of doing things. We will be impact investing pioneers. In the cases I mentioned, all of those, you can tell a story about a dynamic entrepreneur who helped make that happen. The problem with entrepreneurship as the focus is that that is an incredibly important first step. But to go from a period which we've seen of a proliferation of exciting innovation to a period in which this industry can really develop and put more money to work and solve more problems more efficiently, we need to couple that entrepreneurial energy to leadership, industry-building leadership. And so what investors and others have come to us and said is, if this industry is really going to grow quickly and solve problems, we need ways that we as impact investors can work together. Because right now, our world is organized on a binary of solving social problems, making money. When you're an impact investor, where do you go? Do you go to your investment meetings where everyone understands about making money but thinks you're crazy when you talk about social impact? Or do you go to the social, NGO, civil society meetings where everyone thinks it's exciting, you're trying to solve problems, but it doesn't really make sense that you're trying to be an investor? So impact investing needs its own ways to develop leadership. And the big, exciting issue there has been the launch last September of the Global Impact Investing Network. And that is a nonprofit organization which exists to help accelerate, develop, and foster the leadership of this industry so that it can reach its potential. There are other initiatives as well that we've been involved in and others, but that is something that really answers that question of where can leadership come from. The Global Impact Investing Network is not providing leadership. It is facilitating the leadership among leading impact investors to really realize the rest of the agenda. So there are 4 things. The first was leadership. The second thing that people said to us was, we need basic infrastructure. And here, if you're an architect and you build a building, you don't have to think about the fact that there needs to be roads to get the trucks to the building. There needs to be a utility company that brings your gas lines here. There needs to be a financing company that finances the building. For an architect building a building, all of that is the supportive infrastructure. For a mainstream investor, there is lots of supportive infrastructure as well. There are standard ways that you measure the results of your investment. It's called the GAAP standards in many countries, general accounting principles. There are auditing firms. There are investment bankers. There are ratings agencies that help you determine which potential investments are creditworthy. Hopefully they do. I used to get a snicker when I said that about a year ago. I guess it's a sign of our times that people have been lulled back into sort of taking that for granted. But there is a set of supportive infrastructure. If you want to invest in a deal, you know how to find other co-investors. I'd say similarly on the other side of the binary. If you are involved in giving money away, there is increasingly an infrastructure catching up. There are ways increasingly to standardize how you measure the social impact of what you do. There's a policy environment that supports you. There's regulatory frameworks. And increasingly, and some of them are in the room, there are exciting partners who can help you find other people to raise money from and so forth. Impact investing doesn't have that supportive infrastructure. It's a new industry. This is the nature of new industries. And so investors have come to us and said, we need a way that leaders can work and lead, and we need infrastructure. And the two main points of infrastructure I just want to mention, and there are many others, is investors came to us and said, one of the most important pieces of infrastructure is that we need as investors to know how to measure the social impact of the investments we make. So they said to us, when I'm a regular investor, I know the return I got. I got a 12% return, or it's how big my bank account is, I can do the math. When I'm an impact investor and one person says, if you give me money, I will help 20 schools build a classroom, and another person says, I'll help 40 schools build a classroom, we don't know how to compare that. We don't know if that's the right measure. If you care about educational outcomes in the slums of Hyderabad, does the number of classrooms matter? Is it the quality of the teaching? There's a whole set of metrics around measuring social impact that are very important for investors. And so as part of our work, we at Rockefeller and with many partners have helped to create two new organizations. One is called the Impact Reporting Investment Standards, IRIS. IRIS is, those of you in the investment world, it's like the GAP standards. It simply says, let's create a common language, a taxonomy that defines the terms we use when we communicate social impact. So if you say we built 3 classrooms, and someone else says they built 6 classrooms, we need a standard of what the word classroom means. Because if one person is building 4 walls with a computer hookup and air conditioning, and another person is putting tarps around a tree, both of those are very much classrooms in their right context. But as an investor, we need to know how to compare those two. And we can say the same things for jobs programs in Canada or for working with farmers in Congo. So we need a set of common metrics, and we've helped to launch IRIS. The other point is that for many of the people, for those of you in this room who have the appetite to come and hear a talk about impact investing, you might not need a ratings agency because you might have the appetite to go online, to go visit the organizations you want to invest in. We at the Rockefeller Foundation have staff who have the capacity to go and assess these projects. My team was in Nairobi 2 weeks ago. They were in Mexico earlier, really applying their judgment to understand which investees are going to deliver the most social impact in our impact investing portfolio. But for a whole other set of people, and for frankly most of the money we're trying to steer in this direction, they don't have that appetite or the skill to do that. And so having third-party objective ratings so that as an investor you don't need to go out and apply the judgment yourself, but you will know that someone else has, and that a set of investments are impact platinum or impact gold, we believe that could really change the dynamic of this field. And in many ways, the ratings agency, which is what we're building around that concept, is really a piece of infrastructure that is being built for the future of this industry. The current participants, because we are here, have almost signaled by arriving so soon in this industry's development that we are willing to go and make this happen and invest and take the time to develop an understanding of how to measure social impact. We think many more investors don't and will be kept on the sidelines of this industry unless we have standard ratings and credible third-party ratings and standards. At the end of the day, what metrics and the social measurement is about is providing the industry with the tools that enable us to put our marginal investing dollar with the best problem solvers and not just the best storytellers. And not to disparage. And I wish, the ideal is a world in which the best storytellers are also the best problem solvers. Because we need leadership, and part of leadership, and I'll get to that, is going to be about growing an understanding of the power of this industry. But in the meantime, we worry that as investors, without standard ways to compare and measure social impact, 2 things are happening. A lot of people are staying on the sidelines, and they're saying to us, I want to make for-profit investments that create social good, but I'm not convinced that I know which ones of all the options really are going to create social good. So let me just give some money to charity. Or the people who are investing in this field might not be putting their money into the most effective problem solvers. The standards and the ratings will help get us to solve that problem. So I said there were 4 challenges. The first was leadership. The second was infrastructure, and there are many other pieces of infrastructure. There's a whole thing around impact investment banking that I'd be happy to talk about later. The third thing that people said to us was, and here I can't avoid a wonky term, and that is intermediation. The basic point around intermediation is that most of us are never actually going to make investments by finding someone and handing them cash and then having them hand us cash back when their investment pays off. That is not the way the $100 trillion moves. Most of us deposit money in a savings account at a bank, we have a pension, or we buy insurance. Insurance, pensions, and savings, that's most of the world's money. And that money is all intermediated. You want to be an impact investor, but someone else is making the decision about how your money will be invested. And for this industry to take off, we have to create solutions that allow those intermediaries to put your money to work in impact investments that solve social and environmental problems. So what's the problem? Why can't they do it? Well, the reality of the way that the financial services sector works is that most of that money is being aggregated in incredibly large pools. Hundreds of billions or tens of billions of dollars are what most money is managed by intermediaries with large sums of money to place. And so when they seek to make impact investments, if I say to them, there's this great school in Hyderabad, which needs $3,000 loan, someone whose portfolio is to manage $600 million is not going to make $30,000 or $3,000 small loans to those schools. They need to be able to put money into funds. They need to put money into other mechanisms that can take that aggregated money and put it to work. So developing intermediaries who can take the large pools of institutional money and make impact investments happen is a very important aspect of unlocking this. And again, I'm happy to get technical, those of you from the financial services sector, wealth advisors, private bankers. There are huge opportunities in this field. And I would argue that increasingly, and I'll get to this at the end, why you should care is because your clients are going to want this. And we have good examples of this. The best example we have is someone we work quite closely with, and that's the US pension fund TIAA-CREF. Has anyone heard of that? They are the teachers' pension fund in the US, developed by Andrew Carnegie, who observed that many teachers were ending their lives in poverty. And he created a pension fund that allowed teachers in universities and private schools who are not part of the government system to have a pension plan. When we started working with TIAA-CREF in 2007, they had $370 billion under management and had committed to make part of that money to put it to work in impact investments. The man who manages that fund is called Scott Buddy. He manages the fund within TIAA-CREF. He has grown that to $600 million. And when I think of intermediation, I call this the Scott Buddy problem. Scott will laugh when he hears about this. This is the Scott Buddy problem. His boss turned around to him and said, for a set of reasons, our customers want us to become impact investors. So I want you to start making investments that deliver social impact. So that's one constraint. So he was told, take a look at all the universe of potential investments and select those that will have social impact. That's sort of screen number one. The second thing they said to him was, this has to be market rate investment. Impact investing does not necessitate taking lower returns. And this is a great natural experiment because every investment that TIAA-CREF makes by law has to be market rate. That's the laws that govern pension investing in the US. It's called ERISA. He cannot make an investment that his lawyers do not determine his market rate. So from those social impact deals, pull out the ones that aren't going to be market rate and you're left with his universe. The third thing that they didn't say to him, but he knows, is he now has to run a $600 million fund, and they're not giving him an army of investment bankers. They're saying to him, you're going to do that, and you're going to have 2 or 3 professionals in the firm you can work with. So take all of the deals in that universe that are $2,000 and $20,000 and involve going to Eastern Congo and finding that farmers cooperative, take them off the list. And what you're left with is the subset of deals that solve the Scott Buddy intermediation problem, which is where can we make impact investments that drive social and environmental outcomes that are market rate and that are at a scale that actually enables the mainstream pension and insurance companies that manage most of the money in the world to place money. He's done 3 things. Some of you probably could figure out at least 2 of them. He's put a lot of money into green investments, green tech, which for a whole set of reasons has funds that exist, has aggregators who are able to put money to work at scale. The second thing he's done is he's put a lot of money into community development and low-income housing in the US, which starting with a set of supply shocks from the US government in the 1970s through some very interesting policy innovation in the 1990s, has created a huge supply of money that is seeking to be put to work in community investment and in low-income housing development, while the intermediaries showed up to respond to that supply of money. And so Scott Buddy can now solve the Scott Buddy problem by putting his money into cash deposits with community banks, which are aggregated up through a network, into low-income housing, debt, and equity funds. The last way that he solved the Scott Buddy problem, and this is more recent, is in microfinance. And he has been able to, in microfinance, make equity and debt investments. When we look at the promise of impact investing, we cannot realize that promise unless we solve the Scott Buddy problem for many other social problems. And I happen to know, because I know him personally, that Scott Buddy would love to put impact investing capital to work in providing health opportunities, healthcare, in poor countries. He would be very interested in using that capital to support low-income farmers in the poorest parts of the world, capitalize their fields, and drive their own incomes, and many other areas. What is constraining the promise of this industry is not the appetite of investors, but in many cases it's the existence of these intermediaries. And so that's a third challenge, and there's quite a lot of creative things going on. Wanted to mention Jesse in the back, who's trying to solve the Scott Buddy problem by doing one thing, which many people do, and that is to create a fund. Scott Buddy cannot invest directly in companies that are using the mobile phone revolution to drive new business models that could have huge social impact in Africa and elsewhere. Jesse Moore and his new fund, Signal Point, got it right? They can do that. And there are many people like Jesse. They are part of the entrepreneurs who are out there in this phase, and we need to help support them, work with others like it, so we can get, we can meet the investment market where it exists. So there's three things. First was leadership. The second was around infrastructure. The third was intermediation. And then finally, the fourth challenge that we need to overcome is, I don't know the right word, something around advocacy and awareness building, and partly what we're doing here. And this one is quite simple. When you are an entrepreneur, and I hope some of you later on will talk about your own experiences, and I'm sure Jesse would tell you this, probably because we've been in rooms where this has happened. If you're raising a fund, if you're trying to launch a business, if you're trying to launch an asset management business, you want to just be one of these intermediaries, and you walk into a room looking for clients, or you walk into a room looking for investors, or you walk into a room where you really want to work with people who can help you generate the most social return, and you say, I'm an impact investor, you're going to face you're going to be buffeted. So on one side are going to be the financial industry that says, what do you mean impact investing? If you are looking to solve a social problem, you should be a charity, and how can you possibly make money? And then you're going to turn around and you're going to go to the social people, and they're going to say to you, well, what do you mean you're going to be using a for-profit investment to solve a social problem? If you want to solve a social problem, start a charity, start an NGO. This industry cannot succeed when the conversation and all the people trying to build it spend most of their time explaining why they're either not crazy or stupid. We need to spend most of our time explaining why we are the best at doing what we promise to do, so that when Jesse Moore goes into a meeting, I want him to be able to say, I'm starting an impact investing fund, and let me explain to you why, if you invest in my fund, we will deliver the most blended value outcomes, we will give you really good financial return, and we're going to generate substantial social outcomes. And let's have the competition be among who are the best problem solvers, and not have to waste all of our time with pushing back against those buffets. So a lot of our work around advocacy, and we can all participate in this in different ways, is a very simple premise. We are trying to expand the arena in which it is considered both economically feasible and morally acceptable to tackle a social problem with a for-profit investment. That's the overarching story around impact investing. And when that arena is expanded, then we can actually put our attention on taking impact investing money, applying it most productively, both as investors and in the people running these organizations. So the four challenges were leadership, infrastructure, intermediation, and an advocacy that can expand that arena. I don't want to overstate that. I don't think that arena should be expanded so far so that the very important social issues that demand and deserve to be funded by government and by charity are somehow crowded out. This is not about cannibalizing charity, but we do believe that right now that arena is much narrower than it could be, and that ultimately we have to figure out how to engage impact investors in a way that solves problems in complement to philanthropy. So I said I'd tell you what the promise was, what the challenges were, and then the last point, and I'll be quite brief here, is why you should care. I told you why we care as a foundation. We know as a foundation who is seeking to fundamentally change the way the world works and not simply be happy with small solutions, that the social balance sheet is in deficit unless we can tap into some of that money from the for-profit investment world. We also know that increasingly we're not fighting upstream here. There's a whole set of momentum that lets us believe that this is happening and it will happen. Our challenge is just to help accelerate that and steer as much money as we can into the more productive parts of this field. That's why we care. Why should you care? Well, I think there's a few reasons. You mentioned earlier that I teach at Columbia Business School. I think and maybe this has been said for many years, but it certainly seems to me that among the young people I meet in this work, the model that our parents left us, which was your career, you make a choice. You either go out to make money or you go out to solve social problems. And if you go out to solve social problems, get a public policy degree, get a social work degree, go work for an NGO or for government. And if you seek to make money, get an MBA, go work in business, and then at the end of your career, sit on some boards, help give some back. That model is increasingly unsatisfying to a new generation who are being raised in the idea that they can actually apply business skills to solving social problems and that they can integrate in their lives from the beginning the idea of solving social problems and making money. So I think there's a set of you who are probably involved in education. If you're a young person yourself, resist the binary. Don't let people, because we still have systems. I teach at a business school. I went to a policy school. That system still exists, but it's breaking down. So I think for anyone who wants to hire, retain, and motivate young people, I'm not going to deny that on most cases you can get them either with a very compelling social story or lots of money. But on the margins, your best people are not going to be attracted by that proposition. They're not going to stick around because they will have more options to do work that's much more integrated and that integrates purpose and profit in their lives. So I think for any one of us who basically want to engage with the next generation, this is an important point. Anyone in the financial services sector, I spend a lot of time talking to banks. Your private clients, the clients of your wealth advisors, and increasingly your institutional clients in the pension funds are not going to be happy with you simply providing them with a compelling story about how much money you made for them. And so here I have friends who, I had a friend who got very fortunate, was very talented, and sold a company, in fact in his 20s, made millions of dollars. He received 2 phone calls. The one was from the bank telling him, we want to welcome you to our private client bank. We will help you get rich. And by the way, you're going to get another phone call from the partner we have who does philanthropic services, and they're going to help you give away your money. And what he said to them was, well, who's going to help me make for-profit investments that solve social problems? And they don't have an answer to that, but they will. And if the mainstream banks don't, I can tell you right now the startup banks already do, as do their startup wealth advising firms. And there's a lot of market evidence that the idea that a for-profit investment is something that people want to make for social purpose is growing. And I'm not going to be naive. I don't think we're going to get 90 of the $100 trillion moving this way. But on the margins, some really good clients and some really interesting investment opportunities exist. The JP Morgan, one of the most venerable investment banks, launched a social finance unit in 2007 in the investment bank, not in their charity, not in their corporate relations arm. They think they can, as investment bankers, make money in the impact investing sector. TIAA-CREF, a pension fund, now has an impact investing part of their portfolio. So if you're in the financial services sector, this matters. And frankly, if you're just, and then the last thing I want to say is about government. Government has become quite good at regulating that binary. There's a set of regulations that say if you're out to make money, this is what you need to do, and this is how we can control it. And frankly, Canadians, congratulations, you got this a lot better than we did. And on the other side, there's increasingly good government regulation around charity. But all of that has been built on this binary. So the regulation and the policy that we need when we start to try and use and engage this sort of innovation to solve social problems, that needs to be regulated. And it needs to be regulated intelligently. And right now in our society and in every country I know of, there's little things happening here and there. Most government policy is focused on the idea that the regulation about both supporting, spurring, and ensuring the validity of social solutions by the private sector is done through the charity ministry or the social welfare ministry. And the treasury and tax guys who do the finance investing, they are in separate worlds. So what about an impact investing fund? If we as government believe that it's useful to get private citizens engaged in solving social problems, so we give tax breaks to donations, should we give tax breaks to impact investors? And if we do, what are we going to need? How are we going to know who's actually an impact investor and who is just saying they're an impact investor in order to get the tax breaks? This is a hugely complicated issue, and it gets at the heart of how we as societies look at solving social problems. I'm fascinated by politics, with your election here, with the election in the UK, what's going on in the US, about the way that different societies have navigated this challenge. I think in the US, in many ways, a generation ago, we gave up the fight about what is the appropriate frontier between where the government and the private sector solve social problems. I think here and in the UK, you're still contesting that frontier. A lot of the experimentation is about how does the private sector get more engaged in the delivery of services, if not in the payment of those services? Well, impact investing is absolutely about that frontier. And the more engaged you are as a society in trying to determine where that space is, the more interesting conversations you can have about impact investing. But we have to have those conversations because right now, the entrepreneurs out there and the investors out there are force-fitting their aspirations and their actions into a regulatory system that puts them on the binary. So you either set yourself up as a nonprofit fund, even though what you're really doing is investing and you want to have the flexibility that the financial regulations have for for-profit investments, or you put yourself in as a for-profit fund in which a whole set of fiduciary rules apply to you and make it difficult for you to fulfill the social mission. We need to resolve those, and I hope when I come back next, we don't end up saying that the greatest innovation in impact investing policy reform was the 1995 Dutch green bond tax subsidy, which basically gave capital gains tax breaks to Dutch citizens who invested in green investments. Well, that was 15 years ago. There's a lot more to go on. I'm sure there's a lot more happening, and I'd love to hear if anyone has thoughts around what's happening in Canada. So I think young people, anyone working with young people, this matters. If you're in the financial services sector, it clearly matters. If you're in the business of solving social problems, it matters that you now have a new way of thinking about how you're going to capitalize your ideas. And it matters for policy and government. So I just wanted to end there. And just to say that, when I said we have a world in which the problems are accelerating at a complexity and at a scale that our current solutions can't solve them, you might ask why we're still optimistic. And we're optimistic because we believe that in the 21st century, we will innovate and create innovations like impact investing that are worthy of those challenges. I think what the MaRS Center is doing, and the idea of placing social innovation as a central force of how we work and how we think, is the bigger story. Impact investing is one part of that story. But when we see what's going on around the world and the kind of engagement we're getting and others, we're incredibly optimistic that this innovation is one alongside both standing proven practice and new innovations that will allow us, despite the current social balance sheet and the complexity, to create the world that we want to both live in and leave behind. Thanks.
Thanks very much, Antony. You covered a lot of terrain there. So maybe just to kind of bring us back to the current context, you speak very eloquently about increasing complexity, deriving the need for new innovative solutions and approaches. What about the impact of the current financial climate and the sort of hangover of 2009 on the impact investing movement?
Sure.
Has it given money a conscience briefly?
Yeah.
Or how do we leverage this into something that's more sustainable?
That's a great point. I'm glad you mentioned it because I regret giving a talk that I probably could have given 2 years ago without acknowledging this cataclysm that we've not only gone through, but still are going through. And for many of you who work on the front lines of social service delivery, you know that the recession is not a thing of the past. And we certainly know that in our work at Rockefeller. To answer your question, if there are any economists out there, you'll know this is about there's an income effect and there's a substitution effect. The income effect is that people have less money. Foundations, endowments have shrunk. Governments are cutting back. Governments don't have money. Corporations are cutting back. So the income effect would tell us that with less money, there's less money for everything. The substitution effect would argue, well, maybe in light of that shock, more of the little bit of money that's left is going to be applied over here, and ultimately it's going to be a bigger field. So if those of you remembering your microeconomics, we can draw the lines and figure out the shape of the curves, and that'll determine whether it's up or down. What we do know is that neither did the financial crisis suddenly precipitate a massive tidal wave of investments out of mainstream investing into impact investing. That didn't happen. But similarly, neither did the opposite. We did not find that people who were already impact investing suddenly withdrawing and saying, wow, in 2006, I felt like I could put money into a 9% loan to an Indian school, but I don't feel like I can do that now. I think over time, the substitution effect will be powerful. So people are going to look at what happened and say, in a world in which we have less resources, we can no longer be complacent about the social balance sheet. I think before the crisis, there was among some organizations, there was a complacency that said, hey, I'm a well-capitalized foundation. I don't need to innovate. I can give away grants. We have a lot of grant money. Or I'm a government. We can just do things in the old way. We can fund this social service. What is going to happen, and it's not just about the shock, but it's about the reality of the world we live in, and that there is less money in everyone's coffers, which I think is forcing people to innovate. And so there's a greater receptivity to innovation generally. And I think the power of the impact investing story is it says, we are saying we have enough money, even post-crisis. It's simply a matter of taking the money from where it is in for-profit investments that aren't addressing impact and getting it applied to for-profit investments that are also generating impact. I don't think I would worry if this cannibalized philanthropy. I think philanthropy is very important, but we think impact investing can actually be additive. So while people are a little bit shocked, and in 2008 there was a lot of shell shock. There wasn't a lot of new funds getting launched. There weren't a lot of new ideas getting capitalized. We're seeing this coming back very fast. And those people who were impact investors before are just absolutely committed to it, even more so. And that's starting to pave the way for other people to get engaged. But I think 50 years from now, we're going to look back at a pre-impact investing world as a very profligate one, where we actually thought as a society that we could waste our money on just doing for-profit investing, or we could waste money on philanthropy where philanthropy isn't necessary. It is very necessary in certain places. So in that school in Hyderabad, that costs $10 per student per month. By the way, the company that lends to those schools, they lend to, some of the schools charge as little as $4 per student per month, but some of them do charge as much as $10. Well, at $10 per month, that's not going to be able, not everyone can afford that. And so when I said profligate, I think a charity that builds a school that ends up having a student whose family can afford $10 per month, which could have been served by an impact investing loan, is wasting that money on where the charity was really needed. And that is to provide an educational opportunity for the people who can't afford the $10 per schools per month. The fact that we as a social sector are willing to put money to work in deals which could have been capitalized by another source of funds is wasteful. And I think as a financial services industry, the fact that we are willing to make investments where we could generate substantial social good, and yet we're not even paying attention to how that can happen, I think that's wasteful as well. So I'm hoping we've entered an era in which there's less tolerance of waste. But it does take time, and I think one thing I've learned is that capital markets are not governed by reason as much as by ideology. And so part of this is simply, I do think the biggest outcome of the crisis has been the shaking of complacent ideologies about mainstream investing. That there are people out there who a few years ago would have said, the conversation would have stopped when they said, this is not the way we do it. We have our investment theories and they work. I think there's a group of people who've looked at what happened and said, do they really work? And they're not rejecting them, but they at least are now open to other alternatives. As an impact investing industry, we need to build the evidence. Right now, I've given you a lot of anecdotes. I hope some of you sat there and thought, well, the plural of anecdote isn't evidence. We don't know how big this market is. There's a lot of things we still need to do. But when we do it, I think we will find a society that is slightly more open to reason-based argument. Before the recession, I don't think reason alone would have been enough because people were so complacent in how they saw the world.
But it is true that we still come at this sector either from a financial background or from a social services background. I mean, are you really seeing that blended beast emerging and gaining momentum? Mm-hmm. Or is there always going to be this tension between balancing financial and social impact returns?
I think the innovators in this field suffer from being innovators. So I absolutely am seeing organizations that are generating a blended value from impact investing. Some of you here when Jed Emerson spoke, he's been talking about blended value for a long time. But it's really hard. So Root Capital, who are providing the loan to that company in Uganda that's buying from the vanilla and coffee farmers, they now run a $40 million balance sheet. And they're basically investors. They happen to be legally structured as a nonprofit in the US. and they take grant money as well as loan money. So it gets very complicated. And we don't have the language that allows us the shorthand to communicate. We don't have the benchmarks that let us know how that's working. And I think very importantly, we are still figuring out how to put the different pieces together. And I think that's what the pioneers are doing. They are the NGOs like Root Capital that in many ways are actually investors. They are the investment arm of JP Morgan that's putting their money to work in deals that are focused on social outcomes. From both sides of the binary, people are collapsing in and innovating. But it's very complicated and it's hard. And I think first movers suffer from being first movers. The people innovating now are developing the business models. They're developing the standard term sheets. We're working on the metrics, all of which will be available 10 years from now for the people to rush in. But it's happening, but it's complicated. And I think one of the things we don't have any answers for and we need to be very good about, and then as this movement evolves, is being very thoughtful about how impact investing sits alongside government and philanthropy. Mm-hmm. When this movement began, the very idea that a for-profit investment could be both a morally legitimate and economically feasible way to solve a social problem was crazy. And so the first wave of pioneers in this field, I think, had to express a relatively simple message, which said you can make money and do good. And that message was very important. And I couldn't stand here doing what I'm doing if that message hadn't been spoken eloquently and passionately. But to go from, once we've created that space and we're in that arena, then we can be a little bit more comfortable about being a little more sophisticated and saying, really? Is it always the case that you can make money and do good? What are the trade-offs associated with that? In the first phase, people didn't want to talk about the trade-offs because you're approaching a very skeptical world, and nuance doesn't fight entrenched skepticism. But now we're in the next phase where we actually can afford to have some very sophisticated conversations about how do we put philanthropy and government together? What are the trade-offs inherent in how we operate? And how can someone like Root Capital, instead of just having one undifferentiated model, maybe they should spin out a for-profit investment fund. Maybe they should partner for an investment bank to do those deals which are commercial. Then they can take another set of their deals where someone's willing to take a 2% return. You're not going to get an institutional investor in, but maybe someone else who's excited about their work will do that. And then what's the role of charity? So I think the next phase is we've gone through the anecdotal innovation phase. The two things that have to happen now. One is we need to move from anecdote to evidence. We need to get much more thoughtful and fact-based in how we talk about this industry. And we have to become more sophisticated in how we think about this industry operating within an ecosystem of different people trying to solve different social problems in different ways. And I think we've been too siloed and we've been too superficial in how we've articulated that.
How are we going to invest? How are we going to sort of wall off the more insidious factor that money has a funny effect on people, even on good people, and especially if we're successful in mobilizing large amounts of private capital into the system, we likely will see a creep in the emphasis on social return, on the one hand, and on the other side, there's a great impetus right now for good business reasons for large corporations to be seen to be socially responsible, to be at the front end of green stewardship and so on. That between those two, the middle will become so squishy that we will no longer really be targeting the social mission effectively.
Sure, that's a great question. A friend of mine says the challenge with impact investing is to make sure that it's neither too hard nor too easy. And I think what he means by that is you shouldn't have to be a bullheaded pioneer willing to incur years of pain to force fit your aspirations into an existing system that doesn't serve your needs. But at the same time, that's why we want to make it easier. We also want to make sure, so we want to be too hard. We also don't want to be too easy. And I absolutely agree with you that our research shows that there's a gathering interest among investors to get their financial intermediaries to do impact investing. The gravity in the financial services sector will be to go and put that money to work in the easiest things to do. And that's where it becomes too easy. So if those interests of investors to have their money put to work to solve social problems ends up in investment funds and products that appear to be social but don't actually address social problems, then we would have similarly failed to realize the opportunity that this movement presents. How do we avoid that? I think one of the very important issues is around metrics, social performance measurement. We had a whole really interesting conversation about that this afternoon here at MaRS. If we can measure and compare who is generating social impact, it'll make it a lot easier for us to call out those investors putting their money to work in the easy stuff and not the stuff that's really solving problems. So I think standard, much greater transparency. And frankly, we need investors with an appetite to optimize for social impact. I think one of the problems in philanthropy is that many of us, when we make charitable donations, are not focused on the ability of that donation to maximize the social outcomes or the solving of social problems. I think philanthropy is a very complicated mental process. Part of it's a consumptive experience. It helps us feel good. We want to connect with our networks. There's a whole other set of motivations that are not about did we solve a social problem. And so we need that spirit that says we hold our impact investments accountable to its ability to generate social returns, to be deeply embedded in this without being naive about the appetite that the average wealth advisor has, or the average banker has, or the average fund manager has for measuring social metrics. So the work we do around measuring social performance is about building infrastructure that allows the people who actually do move money to have the tools they need to move money to the marginally more productive solution. But we absolutely worry that this will become too easy. And I, when I'm being glib, I don't know if we're on the record, but I don't personally, and certainly institutionally, the Rockefeller Foundation we don't want to be spending our time and money to help rich people feel good about themselves by avoiding giving their money away. And at its worst, that's what impact investing can become. So I worry that it's going to cannibalize good philanthropy. And I worry that even if it doesn't cannibalize philanthropy, it'll be wasted on the less powerful ideas out there. The last thing I'll say is we don't have the answer as to where the money should go. There's a lot of innovation in the business model of how do you actually take money and turn it into financial return and social return. There are a few of those business models that have been successfully innovated. Microfinance being the most powerful. I think we can have a big debate about the social impact of microfinance, but if you accept that within the universe of impact investing, the business model of how do you take money and provide access to finance for very poor people has been solved, I would say, at least to make it sustainable, for a certain set of communities and a certain set of countries. There still needs substantial innovation getting it to Africa, getting the 10 times more people in India who could have, make use of it. But that is a business model, microfinance. 30 years, 40 years ago, it would have been considered crazy that you could take money and invest it by lending it to poor people and generate both investment returns and poverty alleviation. Well, we can do that now. But that business model took 40 years. In the early 1970s, there were a few experiments. Someone put the word microcredit around them and allowed them to sort of connect, work together. It was grant funded by philanthropy throughout the 70s. Increasingly in the 80s, multilateral and bilateral government aid flowed into the sector. In the 90s, a set of infrastructure was built to enable leadership to occur among that sector, to drive the infrastructure development. And so in 2006, Morgan Stanley could go and syndicate a $110 million or $100 million collateralized loan obligation. CLOs and CDOs, they have a bad name, but they served a great purpose and are a very powerful instrument when applied well. But between 1972, when the early experiments started with Grameen and with BRAC and in Brazil, to 2006, that's 34 years of refining the business model to get it to the point where German pensioners could, through their intermediaries, buy an investment that ultimately was capitalizing microfinance banks that were producing social outcomes and profit. 36 years, hundreds, if not millions, if not billions of dollars of subsidy. So let's take that story and learn from it and say there's still a lot of work to be done to innovate the business models, and let's not be naive about what it's going to take, which is partly why we need to have a sophisticated conversation on where subsidy applies as well.
So I have lots more questions, but I'm going to ask just one more before I open the floor up. And that is, I know we're having a conversation here about impact investing, and so when it sounds like it's just a money problem, when we know that, there's also issues with the absorptive capacity of social enterprises to use that money well, and that investors have a tendency that if they go into a field and they have a bad experience, they retreat even further back from where they started. So what about the risks of making sure that all this talk about unleashing money for good will actually give us the results that ultimately will lead to a sustainable industry?
That's a great question. There's a few ways to answer that. We don't think money is the constraint, at least not the interest of investors to put their money to work in this way. But you're absolutely right. I think there are two major binding constraints. One is around intermediation, and the other one is the absorptive capacity of the enterprises. So there needs to be a lot of innovation on the latter. I mean, new business models need to be developed. I think a lot of the ways we've tried to solve both those problems have been taking analogs from either the charity world or the for-profit world and then creating them. So many impact investing funds are raising 7-year, 10-year locked-up private equity funds with a 2% management fee and a 20% carry. That is a model that's just been taken whole cloth from the for-profit world and applied to our sector. We need to have a conversation about what are the structures that will allow us to put our money into intermediaries who might have to participate in helping the absorptive capacity of the enterprises. I worked for an NGO that focused on we were nonprofit, grant funded, but we worked with businesses. Our theory of change was that TechnoServe, by helping rural enterprises grow, that's the best thing we could do to help raise rural incomes and end rural poverty. And I did this in Kenya and Uganda. When we did that, we were a grant funded enterprise, and the absorptive capacity. A lot of what we did is called technical assistance. And anyone in the international development world knows that technical assistance is sort of a stigmatized term. This idea of, well, I would invest in this field. I would be an impact investor, but I've heard that for every dollar I invest, I'm going to have to spend 10 cents on technical assistance. And that's not efficient. And if these companies aren't yet ready, then what are we going to do? Well, two things I'll say about that. One is, in venture capital, technical assistance is called venture capital. I mean, the idea that an investor should be engaged with their investee company and support them to develop is very part of mainstream investing in early stage companies. So I think a lot of when we say, well, these companies aren't ready, then we just need investment models where we can internalize some of that readiness preparation into the investment decision. And maybe that means that impact investors need to give a bigger management fee to their intermediaries. So I think there's one issue around sort of how do we internalize some of that support to the businesses within the work we do. And then the other point is around, again, how do we work with subsidy? I think right now, if you want to help support rural enterprise in East Africa, there's a lot of ways you can throw donor money at it and government money at it. And a lot of our bilaterals, I mean, the Canadians, you've got an investment fund, you've got your Canadian development arm, we have USAID. We spend a lot of money grant funding NGOs to do technical assistance, providing handouts to some of these companies. That's really important, but I would argue that some of that could be done by for-profit investors. Not all of it, but part of it. And so the other thing I'd say, mainstream and venture capitalists do technical assistance. They just don't call it that. Most new industries that get developed also get developed with government subsidy. So there's a very legitimate role historically for governments to step in and say, the development of this new industry will actually be a public good. And therefore, it is appropriate for us either to fund and subsidize its kickstarting, or frankly, if the business models will never internalize the full public goods, getting back to the language of economics, then maybe the most effective way to deliver those public goods is by subsidizing the technical assistance to businesses who can then absorb the impact investing money. So we're not trying to remove the need for government and charity. We're just saying, let's be very tactical. Let's focus it where it is most leveraged. But again, this is part of this sort of phase 2 sophisticated conversation. I think a year or two ago, people wouldn't have been comfortable saying, yes, maybe we need subsidies for that. I think in some businesses we do. We think of subsidies having a very clear set of rationales. Even though we're working with investors, we think subsidies are appropriate in 3 very clear areas. One is, if the business model generates a substantial public good that cannot be internalized into the economics of the business, then it is a very efficient way to achieve a social outcome by subsidizing it. So if there is someone who's creating a hospital that serves, and this is an Acumen Fund investee in India, that creates low-cost, quality maternal care for mothers. Well, it could be that ultimately that creates so much public good, but you simply can't run that business model unless you charge, and I'm totally making the numbers up, $200 per service. Well, maybe if you can only charge $100, you can access a whole other range of poor people. So maybe a $100 subsidy in perpetuity is totally appropriate, because the public good being generated by that service is going to be far outweighed from that subsidy, and it'll never be internalized in the business. I think the other area we think of subsidies is if the market is mispricing risk. So if it's the fact that to lend to smallholder farmers in rural Uganda, you can actually do that reliably, and as an investor, you don't need subsidies. It's not a very risky investment, but the market thinks it is. Then I think we can come in and subsidize that, the demonstration of that. We did this. We put a loan guarantee into a microfinance bank in Uganda because we, at the Rockefeller Foundation, realized that there was this dynamic in the marketplace that allowed those farmers to be more better risks. So they're a short-term subsidy that can prove out risk. And then the third thing is there are some network effects, and I think the economics literature has shown this, that where once they're developed, industries might be very viable, but they won't emerge organically from the marketplace. And there I think it's also very appropriate to say, can we put in subsidy? Again, governments have done this. The venture capital, mainstream venture capital industry was subsidized by the US government because the Defense Department in the 1950s said it's really important for our long-term health that we've got a pipeline of early stage companies doing really crazy innovation that we can eventually take. And so to get that done, they basically seed funded a bunch of early venture capital firms, all of which failed. Why? Because they hadn't figured out the business model doing venture capital. Well, 30 years later, that business model worked. In 1980 or 82, Apple IPOs. And suddenly the venture capital industry has its kind of coming out moment. And now you don't need government money to support that. We can tell that story in lots of places. I think in Canada, looking at, and we do this in the US, sort of are there communities where it would be really useful to have more investment, whether that's in Aboriginal areas, whether that's in certain areas of poverty in cities. I mean, lots of places where you can try and apply that in a thoughtful way.
Mm-hmm. Okay, we have a whole lineup. Go ahead.
Good evening. Very, very good presentation. I
gonna
actually
stand up so I
have
can
a
see.
comment and a question. The comment has to do with, I think, a very useful set of information or background information has to do with Islamic economics and Islamic finance. I think there's a very long tradition there on how to translate impact investment into that experience. And I think it makes a really good research question for perhaps a master's or a PhD thesis. I also wanted to ask you a provocative question, which is to do with this ethical, moral arena that you mentioned, which is this question of expanding into social investment with a for-profit perspective. And specifically, the question has to do with reconstruction efforts. There's been recently earthquakes in both Haiti and Chile. So this is a very topical question for many of us. Mm-hmm. Where do you see the role of impact investment, particularly in reconstruction efforts? And I'm particularly, if you could think even further on the question, because the problem when there is a disaster, apparently the first weeks, months, determine the investment decisions that will be made that will determine how reconstruction will take place. So it's very difficult to start a new paradigm of construction in an area that it's dominated by conventional thinking. Mm-hmm. So specifically, for example, building homes that can heat and cool themselves through right. proper efficiency, conservation, renewable energy. Mm-hmm. It's a very difficult idea to introduce when people are very concerned about sure. stability. Yep. So it's a big question, but perhaps mm-hmm. if you can reflect on it. Thank you.
Do you want me to answer that or to take a few?
Sure.
So I think the two great points. On Islamic finance, the broader point here is impact investing is not new. I would argue that the binary is new. The idea that our wealth as a society should be put to work to be a steward of the social good as well as to make money, that's the old idea. The idea that we should separate in our minds and our lives, making money over here and solving social problems over there, that's the innovation. So Islamic finance is one way we see this. Microfinance, Jonathan Swift, the author, he was a priest in the UK or in Ireland, and he ran what is effectively a microfinance scheme. And when you go back in history, this basic idea, and the basic idea that those with wealth had a responsibility to be stewards of their societies. I'm a conservative. I just want to go back to the way things were. So Islamic finance is one set of learnings we can draw on. There are many others. And frankly, that binary is most pronounced in the Anglo-capitalist tradition of the late 20th century. So even in continental capitalism, it's moderated. The idea of stakeholders is a much more core nature of how, for instance, the German and the French think of capitalism. So, I think there's a lot we can learn from history. On the point about reconstruction and what is the appropriate role of impact investing, I think, first of all, I want to say adamantly that experimenting on the most poor and vulnerable people in the world is unacceptable. And so to go to a place like Haiti and say, oh, great, we've been waiting for a test tube to push our new ideas, I absolutely would not want to be supporting that idea. You are right, though. I think there are many ways in which this could be helpful all over the world, and the most poor and vulnerable communities in post-Reconstruction or war-torn and then post-Reconstruction are the people who need the most innovative approaches. I would want to believe that we should be saying, again, this isn't an ideology, this is just a tool. So in a situation like Haiti, relief is a really powerful tool. Government aid is a powerful tool. The military showing up and restoring order is a powerful tool. And impact investing should have its place. I think impact investing there's really two very high-level filters. One is, can the social and environmental problem be solved by a business model that generates profit and therefore can repay investors? And the second one is, are we looking at an issue where the capital needs cannot be filled by government and charity? And I would say in the case of Haiti and many reconstruction efforts, it's clear on the second that the capital made available even when people donate is not enough. But it's unclear on the first. I have not found a business model yet that I feel incredibly comfortable with that says we can go in immediately after something like that and produce a credible, morally legitimate, sort of well-functioning business model that provides services. At the same time, I suspect that what happened in Haiti was, as soon as the earthquake hit, the price of water skyrocketed. So what about an impact investor who says, we're going to create an innovation where we're able to deliver clean water, and we've got some sort of covenant with our investors and with other stakeholders that we will not maximize our prices, but we'll deliver the most water possible at a reasonable return that allows us to scale that up. That would be a really interesting way to get basic services delivered much more quickly. I think in a place like Haiti, the moralists might argue, how dare you move in a place like that and try and make money? But the reality of the lives of poor people is people are already making money on them the hour after that earthquake happened. And so can impact investing come in and say there's another way we can do this that doesn't necessitate making money? But I would not want impact investors to going into Haiti and crowding out relief. Or I would not want impact investors to go into a situation like that and have people diverting their good philanthropy to impact investment. I'm happy if they divert their ineffective philanthropy. But I think that's a very dangerous and careful place. And I do think there are limits. And again, I want to emphasize, impact investing is about finding the appropriate boundaries and then working together effectively. I think in the post-Reconstruction, without putting a lot of thought into it, I think it's sequencing. It's doing the post-Reconstruction phase in a way that enables the impact investors to get in at the right moment and to do it at scale. And there are choices you make in the reconstruction phase that can make that more or harder to do. But I wouldn't say that that's the first place I'd want to see us jumping in.
Maybe I can just ask our next questioner to identify herself.
I'm Agnes Couture, University of Toronto. You've touched on these in a number of ways. I'm trying to see how I could best ask the question without asking you to solve all the problems of the world all at once. But you touched on it. Being conservative and being, we wouldn't want to bring this into Haiti and sell poor people water. Now, my initial reaction to your story, and first of all, I should just say that I'm all in favor of doing well by doing good. I think everybody would like to do that. But in the situation you mentioned, in the situation in Hyderabad, the little girl going to school, paying $10 a month, sounds wonderful, except that in a situation where little girls are not very likely to get that kind of support from their families to even pay $10 a month. Why, part of the unintended consequence of something like this, and the same thing was for philanthropy, and the same 800-pound gorilla is that if you fill in the space where governments ought to be. In other words, why isn't the public school good enough so that little girl can go for a good education for free, and therefore she's going to have a much better chance of going if her family doesn't have to shell out the $10, which could be a lot of money for them. And given that they probably have other boys who have to go to school, she's probably not going to get the money to keep going. So it's all very well to say that this is a better deal than otherwise, but if you do this kind of thing, and the unintended consequence is that the government gets off scot-free, carries on its corrupt and inept ways of governing, and so therefore things don't get corrected, which is not to say not to do it at all. I'm just saying I would like to be interested in your thoughts on this. And the other side of this is that to say, well, okay, the people are already getting ripped off for water, people who don't have any money and have absolutely nothing because they were utterly destitute and many of them injured and all the rest of it, to charge them money at all, I think, is criminal, frankly. And just because there are other criminals doing it a lot more doesn't necessarily justify it morally. And I mean, just the very thought of it just makes my blood boil. And there's some things are basic human rights, and you were on that field, and so I didn't want to get sort of into the passion side of things, but there is a larger question: is that what are the unintended consequences here? And same thing for philanthropy as well. I mean, if you take over for the government can spend all this money on arms. Mm-hmm. So anyhow, just your thoughts if you have any.
I love that question. When I worked for the African National Congress, there was a controversy there where we were a coalition that included a sort of left-leaning socialist core and then a very strong communist party. And they made a similar point. They said, well, if we provide basic, really tiny houses to everyone, won't that suppress their revolutionary spirit to overthrow the owners of production and have the communist revolution, which is really what we need to create the society we want? I mean, so that there is that idea that, ameliorating suffering is in the long terms not in the best interest of people because it suppresses true revolutionary change. I think that's a well-reasoned and point of view that some people have. For me, I'm a little more simple-minded. I just look around the world at the amount of suffering we can alleviate right now with the ideas we have and the money we have, and I say, having worked with poor people and who didn't have access to irrigation, who didn't have access to improved seeds and so forth, I find it to be it's an intellectually satisfying argument, but one that's emotionally very difficult to hold on to. The idea that we should not apply a solution that could radically improve people's basic lives so as to maintain their revolutionary spirit. Now, if you think the revolution's coming, then maybe I'm being short-sighted, and at the end of the day, their grandchildren will have a worse off life because of what we did. I'm willing to take the world I was born into and say, the revolution is probably not coming in that form, and so we need to make the systems we have work better. At the same time, this issue around what's the right role of government is a really important one. In an environment in which the government is poised to provide services, there are strong arguments, and education is a really good one, that why government should be the natural provider of that service. Again, it is a generation or more away in many of the places in which impact investing money is being put to work. And that's just sort of abroad. What about here in Toronto? The government, you could argue that the moral obligation of the government is to provide all of the jobs training programs out there. But I'd say, two things about that. One is social innovation. A lot of what goes on here, I'm sure, is pointing to the fact that a lot of the innovation about how we solve social problems will not come from government. And so impact investing can be a way of putting risk capital to work to fund the kinds of innovations in social service delivery that the governments, by the nature of government, won't do, because government is not set up to be a risk taker. The capital markets are. So I think there's an interesting story around the interplay between government and impact investing, which doesn't say one crowds out the other, but says that one is the natural incubator of innovation, and that the role of government is to scale up proven ideas, and the role of impact investing is to demonstrate what works and the innovations that work. So I think there's different ways you can get into that. On the issue of being criminal because we sell water to poor people, and that's a great challenge. Again, and that's a very real one. Maybe you'll say, how can you invest in someone who makes money selling goods to poor people? And I go back and I say, well, poor people already pay more for their water than any of us do. And they pay more for their education. And frankly, they don't have an option to go to a government school, so it's that $10 school or nothing. So I am relatively comfortable that, again, on the short-term basis, it is, if the counterfactual for a poor person in the slums of Nairobi is to get water at 10 times what a middle-class person pays for from the dealers in their neighborhood, or at twice what a middle-class person pays for from the impact investee, I'm quite comfortable backing that investee. Because while getting access to water is a human right, that's not a reality in their lives. So I might be criminal against a hypothetical reality, but again, in the reality that I'm born into, at that moment, I don't think I'm criminal at all. To your point, though, if I, by doing that, am stopping the very imminent arrival of free water, you could certainly call me to account. And again, going back to the metrics point, let's actually measure what we're doing here. And your unintended consequences point, absolutely right. I think all over the place we see that. You're right. If those schools are not making sure that there's gender equality, then there's long-term inequalities that are entrenching in that society. So one of my worries is that business people and investors tend to be more simple-minded. I don't want to insult anyone, but those of us engaged deeply in solving social problems have a much more nuanced and sophisticated view of the world. It's partly why we sort of talk so much, and it's partly why we're not so efficient. Business people have really reduced it down to some simple metrics, and it's dangerous if that reductivist instinct doesn't allow us to see the unintended consequences. So I think it's a very good caution.
Thanks. My name is Dragan Stojanovic. You mentioned at the end and throughout your talk the importance of the social metrics and really measuring that sort of social balance sheet. I'm really interested in you maybe commenting a little bit more about how do you envision that going through, and what's your approach to that? Because not only is that sort of a daunting task, but it's bound to be filled with sort of ideological and value differences.
Yeah.
Specifically, I'm very interested in your thoughts on how do you embed in those metrics the sort of a time measurement, the sort of value of short-term versus long-term. I know it's a broad question, but I'd really appreciate your comments.
Yes. That's great. I can talk a little bit about the work we're doing around measuring social performance. I said this earlier today in my other talk. I think that's a more compelling way to describe this. I probably use the word social metrics. If I come back a year from now, I won't be using that term. Metrics are sort of wonky. No one gets excited about metrics. When we're talking about how do we measure social performance, I think that's something we can sort of really understand and get excited about. I will briefly mention that what we're doing in that front, but to your point about the value, value of time is one. How do you relatively trade off between gender equality and poverty? There's a whole set of value judgments that I think can't be avoided when we deal with this problem. So how do we deal with it? Well, we need to make those value judgments in our measurement systems. We need to make them incredibly transparent, and we need to make them incredibly collaborative in how they are improved over time. And we need to use the social measurement agenda as a way to push our own thinking about those trade-offs. There's a lot of, around the issue of the value of time, $1 now versus $1 10 years from now, and what does that mean for a poor person? There's a lot of interesting research coming out of behavioral economics on that. There's interesting research coming out of complexity economics, coming out of development. I think there's a lot of ways we can bring on. I think the social measurement agenda creates a hook for a lot of these discussions. It doesn't avoid them. But it's, and it's very important. The other thing I'd say about social measurement, again, our game in the impact investing space is to get access to that 100 trillion. A lot of the money in philanthropy is already there, and it has its own reasons for going where it goes. What we think the credible measurement of social performance can unlock a lot of that other money that's not here. And to your point about how hard it is to measure, I said this earlier today, that we need a social measurement system that the activists and the academics find to be too superficial and too easy, and that the entrepreneurs and the investors find to be too onerous and too rigorous. And as long as everyone hates us, then we're going to know we found the right balance. Because if we have a system that the academics like and the people who come to social metrics meetings like, it's never going to be practically usable. Because to get the kind of counterfactual, rigorous, double-blind studies going, no one trying to get a vanilla and coffee export business out of Uganda going is going to be involved in that. At the same time, if it's too easy, and all we say is to the Ugandan is check a box that says you care about poor people, well, then we're going to have the problem that we mentioned earlier, which is all this money is going to flow and it's not going to make a difference. So that's a very abstract way, but I think that's an important point because a lot of other efforts around social metrics have been driven by one of those two agendas and have served them. We're trying to make everyone mad. Now, that's not easy. I don't recommend a business plan where your goal is to have no constituents left. It takes kind of, but it's going to take public subsidy for that reason. It's going to take some role. There's going to be a role for grant funding. There's going to be a role for impact investment. Very briefly, we're doing two things on this front. One is supporting a group that's developing a set of standard measures for how you report on social outcomes. It's called IRIS, the Impact Reporting Investment Standards. We think of that like the GAP standards. There's no value judgments in IRIS. All it says is, if you're going to measure education or housing, just do it in a way consistent with the way everyone else is. Just like investors, when they say we generated X amount of dollars of net income or gross profit or net profit, those terms mean something and are comparable. IRIS is online, it's totally available, anyone can adopt it. All it says is if you're going to measure something, be consistent with how we now have 400 things we measure. The other one is where the value judgment comes in, and that's on using the IRIS data to then create a rating system. So we are going to create, us, but we're going to help work with people who will create it's a ratings agency for social impact. So you, as a fund manager, as an investee, will be able to get up and say, you'll call these guys up and say, I want to be rated. And they're going to have like any ratings agency, it's a combination of quantitative and qualitative measures that take the social impacts you're generating and turn it into a judgment about your social impact. Not on a kind of 1 to 100 scale, like 92.4 versus 92, but rather kind of gold, platinum, silver. Now, when Gears gets going this year, it's not going to be perfect. It's going to be bad. But built into it is it's going to be improved over time by the community. And that's the way we're sort of going to try and deal with that. But at the end of the day, there's going to be judgments. The nice thing about Gears is it's kind of modular, so if you really care about one outcome like environment more than another one like job creation, you can weight the ratings yourself. But at the end of the day, we can't shy away from ratings. All we can do is I want a competitive field out there where lots of people create ratings agencies. If you think your judgment is better than others, go out and launch a business creating ratings, and then if you're right, more money will steer in the direction of your judgment.
Alison just reminded me that Antony actually has to leave, and he's going to have people really mad at him at the other end. So I'm going to allow one more question to the gentleman over here.
Great. Thanks. I'll try to make it quick. My name is Jeff Moore. I'm with Deutsche Bank in the institutional asset management arm, and I've done work with our global social investments funds group. My question is, even though I've been in the industry for a long time, anybody I bring up impact investing to immediately defaults to, I get it, it's SRI, right? It's ESG, it's the standard negative screening, or trying to screen, existing public companies for different environmental social metrics. Obviously, we're talking about something slightly different, which is creating companies that have an environmental or social mission but will be profitable. So what I want to ask is, as I've tried to get more of a grasp on the industry, and you're talking about scaling it and leadership and all of this, how much interaction is there now with the existing socially responsible investing community that are tied into consultants, that are tied into pension plans, to lever what they've been able to do, whether you define this as some type of subset, a separate asset class, et cetera?
That's a great question. So let me say that we screwed up. And when we began this work, at least at Rockefeller, look, a lot of this impact investing work has been going on for years, long before I got involved. But I think we did not think about how our work was part of an evolution that includes and really reached a lot of momentum in the ESG movement. So to answer your question, how are we working with them? We are increasingly becoming more effective at building those links. Basically, for those of you not from the financial world, for most people, social investing, at least in the West, means screening your investments initially to avoid companies that did bad things like market cigarettes to children or sell arms to apartheid. And increasingly, the mainstream social investment movement is also becoming more activist. So it's not just what do we avoid doing, it's also how do we engage with the companies we do own stock in to try and push them. And I think there it starts to get a little bit closer to where we are. But your basic insight, which is we are complementary but different. And impact investing is about the active placement of capital into businesses that are seeking to solve social problems. I think as we become more thoughtful about our own definition, because we're not very clear about what's in and what's out yet. I think it'll become even more clear what that means. But we certainly engage with them. One thing I'd say for the financial services people here is the social investment story has largely been a public equity story. And public equities is where most of the institutional money is. Ours has largely been a private market story because it is harder to draw a credible link between an investment and a social outcome when you're buying a stock. And it's very easy to do when you're providing debt, depositing cash, or especially putting an equity investment in a privately held company. So most of my work and all the examples I had for you were debt and private equity. There are some practices on the edge of the most radical edge of the public equity social investing world that start to kind of get to where our work is, but we absolutely stand on the shoulders of that movement. But I do think that this is another and distinct branch of the tree. It's not better or worse, it's just we're doing something different. I think we have, because our focus, there's a smaller pool we play in, because we don't really have as much to say about the public equities market. And all the metrics I've been talking about, that's really private and debt focused. But there's definitely, it's complementary. I mean, I couldn't be doing what I'm doing if the apartheid guys and the green guys in the 90s hadn't been creating the ESG movement.
Well, I am cognizant of the time, so unfortunately I am going to end us here. And I know I speak on behalf of everybody as I'm listening to Antony. I mean, you know, in this very articulate stream, there's just layers and layers of nuance that I know all of us will be thinking about over the days to come. So thank you so much for being so generous with your time and your thinking and your ideas. We look forward to taking advantage of your personal reasons to come to Toronto to bring you back, because this is a fast-moving field, and I'm sure we'll have a different conversation even a year from now based on our own tentacles out into the Canadian market. So, Antony, thank you so much for your leadership in this field, and thank you so much for being at MaRS and sharing that with us.
Thank you.
Thank you.